Oh, we're in a beautiful situation, my friend. We are in a beautiful situation. What I want to do is I want to hop straight into things, and I want to make kind of a crazy statement here. Exactly like you said, S&P on highs, Nasdaq on highs. We're in a really great situation for the indices, but commodities like gold are in a very precarious situation. Oftentimes we talk about gold and indices as opposite kind of assets. So some assets are risk on, some assets are risk off. In my opinion, where gold is right now is not great for the asset. Let me break it down for you. When you're looking at the chart for gold, we saw a pop yesterday. Like you said, we got some news, and things responded off of that news, right? So we're looking at the news. We got some CPI data that suggested that, hey, we got some easing going on. The Federal Reserve is going to be super happy to see that. Month over month, we got zero point 0.3 versus zero point 0.4 expected. Whoop-de-doo. We saw 3.4 year over year. 3.4 is exactly what we had forecasted, but it's not a miss, right? It's a beat, which is fantastic for the Federal Reserve and what they're perceiving. What I think is special here is gold is finding strength in a time when they should be weak. In my opinion, not only do I believe we should not be buying gold, not only am I not buying it, I think we should be shorting it heading into the summer. Just a quick summary, gold has been finding really strong lows over the past few weeks as things have slowed down. A lot of geopolitical pressures are starting to fizzle away into the background. We're starting to see indices, assets that are opposite to gold, find considerable more strength. And the dollar is continually stronger day after day, night after night, because the Federal Reserve is so resilient and they're so unwilling to cut rates. For these three reasons, not only do I think you shouldn't be buying gold, but I think as we get higher, you should be looking for an opportunity to short it. Let me break it down a little bit more for you. So look, I can't argue with the fact that we're on highs, right? We're very, very, very close to highs. And buying low and selling high is one of the fundamental things to trading, but selling too high, buying too low is a great way to get chopped up. It is. It is. I won't argue with that. What I will argue with is I do not believe that this run up with gold is a valid one. Looking at the daily, we really started running up as we got more and more data suggesting that one, the Federal Reserve could be looking at cutting rates because we've gotten some really favorable data regarding the unemployment rate, regarding CPI, regarding PPI, a lot of these kinds of numbers. Not only have we received that kind of data, but let's face it, in the face of war, in the face of uncertainty, gold has a tendency to gain value. Of course, I get it. So why are you saying the opposite, Aaron? Well, let's expand on a few points I made earlier. One, we finally saw a really nice low that started back in the end of April and ended right towards the beginning of May. We saw a beautiful low get made here. So a pullback that we haven't seen. And let's face it, we haven't seen it in months. Last time we saw a pullback like this was all the way back here in December, and it wasn't nearly as deep as this pullback that we're seeing now. One thing I did was over some research, looked at 25 years of performance in gold. In the summer, you have about a coin flip, 55% chance to see gold gain strength or about a 45% chance to see gold gain weakness. It's really dependent upon what's fundamentally going on and technically going on within the space. I argue that as we get up here, I think we're going to make an attempt to find highs. But as the Nasdaq, as the S&P, as the dollar continue to gain their strength and continue to stay on highs, I think that we're going to form more dojis, and I think we're going to see a deeper pullback, a deeper push in gold because of those dojis. Not just that, but looking at some of the more fundamental data, you know, some data would suggest, like I said before, gold prices definitely got stronger as CPI put rate cuts into focus. That's totally fine. We saw the spot index rise. We saw the June contract for gold more or less steady out because of core CPI, softer than expected retail sales, all that fun stuff. But when you look at things like the handy dandy Fed tool, the Fed Watch tool, we're still seeing more or less business as usual. What do I mean by that? Well, the next meeting we're going to have is in June. It looks like there's a 91.6% chance that we see rates unchanged. July, we see a 65% chance we see rates unchanged. September, 51% chance that we see a 25% rate cut. Guys, we've seen these numbers time and time again. The Fed Watch tool has been telling us we should be expecting a cut. We should be expecting a cut. What has the Federal Reserve been telling us? They're data dependent and they want to see this data slow down and slow down considerably. I'm sorry, but a point 0.1 change month over month, even if it's in our favor, I don't think that's strong enough for the Federal Reserve to make drastic decisions. And when you look at gold demand trends, this is being pulled from gold.org, an organization that does research on gold and solely gold. You have a lot of data suggesting that central banks but continued to buy a ton of gold at pace in Q1, but they've slowed down considerably as demand has slowed down. In the full year of 2023, gold demand fell 5%. It has increased a little bit, 3% year over year, showing a very, very, very strong first quarter. But the reality of things is, as we continually find more and more strength in the dollar, more and more strength in the S&P, more and more strength in the NASDAQ, I believe that investors, as they've already started showing by its performance last year, I believe that investors are going to continually wonder, why am I putting my money in gold and earning 2-3% a year when I could be putting it in the NASDAQ? I could be putting it in NVIDIA. I could be putting it in the US dollar and earning considerable more gains, considerably
or their own bank
more
accounts, right?
valuable gains.
A savings account yields much higher rates than they are than what you're saying on gold, right? I've seen savings accounts upwards of 5.5, even 6%, depending on how much you're putting away, and your banking relationships. You know, one of the things I've noticed here lately is that we've started to see the inverse correlation again of the dollar against the market itself, but we have seen strength all across the board. And so if you're looking at you know, where we could, you know, if we're looking to diversify, if we're looking to invest, there are a lot of opportunities out there to do so. And I would say that gold hasn't necessarily been the most attractive, right? If you were buying coffee, right, you would have seen yields upwards of 600% over the past year. So it's all dependent on what it is. So I do agree with your sentiment that the only thing that gives me a little bit of pause on that is that strong upward trend that we've seen here recently. So if we do double top from there, we do have a base of support that's not too far from the top. And so if you're trading this strategy, know that it's going to trend and know that how you're going to manage that position as we try to ride this back to the downside.
100%. It's a hot take. It is. It's a hot take. And I hate gold. And so it might be a hot take from someone who is a little bit biased.
A little bit of bias.
I don't believe
Yeah.
I don't believe that the shiny thing should be making it nearly as much money as it is. You know, when we look at supply, and things in terms of how much gold has actually been produced. We have been producing an incredible amount of supply as well. Supply and demand, basic economics. As the supply continually rises and demand continually falls, price generally has a tendency to fall until that supply ends up balancing itself out. I think there's a lot of data that could point just into either direction. I am taking this hot take primarily because of where I think the Federal Reserve's mind is and where I think they're hanging their hat, and also because of little breadcrumbs here and there. The fact that we've increased production so much year over year, and everyone's expecting that to have a kind of return. The fact that we're pushing higher on gold here, but we're not pushing on as strong a volume as we have been previously. I need to be able to add a volume to this chart, but that's something I can do later. But the core conversation, the core difficulty I'm having with buying this thing is the fact that so many of the assets that generally work against gold are performing so incredibly, and I don't trust it. I don't trust it. I don't think it's worthwhile. I don't think we should be buying this thing. Not only do I believe we shouldn't be buying it, not only am I not buying it, I'm trying to short it.